Right, welcome to JEDIC's tutorial once again. For today's class, we're going to be looking at market structure. It's going to be the introductory class to market structure. But of course, before you dive in, I would of course recommend you go through the previous tutorials that we've organized on this course. Right, remember, it is your one and only ultimate guide to trading from TEDx Traders. All right, let's get to dive in. Now, people get to wonder what is market structure all about? And of course, I keep saying this market structure is the behavior of the market. It's just a study of how the market itself behave generally. Okay, so and it doesn't have any form of hidden secrets. Well, for us, what we are in for is just to look at the market and get to tell ourselves what it is about and how we can make use of the market to our own profit. Right, let's get the details then. Now, the market structure is in forex trading, especially focuses on market types, refers to the difficult patterns and behaviors of price movements on the currency market. Right now, this is just an overview, so I just want to take you through this. You can have time to read it all by yourself. And then, just as I said, it is the behavior of the market. How does the market move? How are candles printed? So your knowledge about these stuffs will go a long way to determine your behavior or your rate of success in the market. This is one of the most fundamental knowledge every one trader out there would always have, because without it, there is no how you're going to be making sure predictions on the market. All right, let's get to dive in. Right, we have two types of markets. We have the trending market and the ranging market. So let's start with the first one. The trending markets here is a case or a scenario where you have the market printing some sort of higher highs and then let's say high and lows. So we have here a trending market occurs when the price moves consistently in one direction. Okay, so and the one direction could be the upward or bullish, or then that downward or bearish, forming a clear pattern of higher highs and then higher lows. That's for uptrend. And for downtrend, we have lower highs and then lower lows. How do we get to know this? Remember, we said that we have two types of trending markets, which is the bullish trend and then the bearish trend. Now, for bullish trend, price rise driven by strong buying pressure. For example, in Euro USD, consistent higher closes indicates buyer dominance, while of course in the case of the bearish, price falls driven by selling pressure, lower closes and decline momentum signaling bearish control. Right, these are terminologies I want to believe you're not used to. So how do we get to identify these trend patterns? How do we get to know that this is the pattern that is at play? This is what this is about. For chart pattern, you always have, for a trending market, you always have higher highs and then lower lows, and then of course visible on candlestick chart. Okay, but if you're using tools like indicators, you make use of moving averages as 200 period, 50 period, as the case may be, depending on the type of trend you're looking at. Then we align in aligned in the trend direction. Or you can also have ADX, that's average directional index above 25 confirms strong trend. Okay, and then this is how to approach the market. This is not so much of our concern for now. Now let's get to look at this. So this is what trending market looks like. Sorry, my battery is low. I hope it carries us to get this done. Now for it, an uptrend, you have a push up, call it a high, a retracement, call it a low, another push up, call it a higher high. Why? Because this high is higher than the previous, and then a pushback, call it a higher low. Why? This is a low, this is a low, but this low is higher than the previous low. That is for uptrend. And the reverse is the case for downtrend. It sells down, retraces up, creates a high, push ups a bit more down in strong momentum, creates a lower low, and then push ups lower high, as the case may be. This is just an ideal form of the structure. Okay, And then for ranging market, we're saying that in this case, market occurs when price oscillates between definite levels of support and resistance, okay, lacking a clear direction. In ranging market, we don't know if the market is going up or is coming down. Okay, that is clearly what is obtainable here. The characteristics is that price bounce between horizontal support regions and then often occurs when there is low volatility and then also common in pairs with stable fundamentals. All right. Now, how do you identify it? From the chart pattern, it forms a kind of box. Yes, you're going to see it shortly. And then the tools to get this, if you're using tools, is the Bollinger Band, and then showing low volatility or the RSI oscillators. These are all indicators. Okay. The approach, just as I said for now, you can, of course, I'm going to share this with you. Then the approach is you're going to be selling from resistance, and of course, you're going to be buying at support. Okay, so let's see. This is an example of a ranging market. Now you see that for ranging market, we don't know if we are going high, right? The market is just oscillating, it's just moving up, moving down, almost at the same level. So this is a ranging market. This is the brief of what this class is going to hold about. The B section of this very class, we're going to be looking at this on the chart. Remember, we said ideal, meaning that in real life, this may not be the exact way that is going to be. Catch up with you much later. Do have a wonderful day. Bye.